news, lots on the agenda today. We have U.S. President Donald Trump's latest trade deal. We have the impact of artificial intelligence on corporations. Let's wrap up what this may mean for your bottom line. We're joined by Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, always great to see you. Thank you very much indeed for joining us.
Betcha, good morning.
What's your take on the trade front? Is this good news for stocks? Washington reaching these framework deals with Japan and Europe?
Yeah, one less area of uncertainty certainly helps support the rally back that we've seen in the markets. Markets have been factoring in this. And so the more progress that we're making on the trade front, the more stability it will provide to this current market momentum.
We've seen, maybe you'll put up a one-year chart for the S&P 500. We've seen a lack of volatility over the past few weeks, but we did see that, although the market, day-to-day volatility, although the market's been going up to record highs. We did see that violent swing, though, didn't we, earlier this year amid fears of a trade war?
We've seen a lot of violent swings the last 5 years. We've got a little bit of a reprieve here and has become a little bit more short-sighted. We tend to forget what's happened more recently, but you're right. Earlier in the year, we had S&P and NASDAQ 25 to 35% off their highs and then rocketing back. 2022, the S&P dropped 25%, NASDAQ 33%. 2020, we saw a 30% drop in weeks in COVID. And 2018, we saw a Fed tightening and a correction there. So we in the S&P, it's been a lot of ups and downs, absolutely.
What is your take right now? We're moving into a time, something of a doldrums for the market, particularly September and October can be dangerous. I don't know how much time you devote to seasonal factors, Martin, but is there a risk the market goes sideways or even down in the next few months?
Absolutely. So I want to provide some context. I'm getting a little bit of flack for being too bearish per se on social media and such. I'm a risk manager, and so I'm always identifying levels of risk in the market. There's two ways, I call it the cost of entry, two ways of playing this. One is to be buying the dips and averaging in on as we're seeing market corrections, and that's worked out well. But for those who are retired or nearing retirement, seeing those kinds of swings that we've seen the last 5 years can be really hard to weather. So let's just say you're retired and your portfolio went from $1 million down to 600,000 or 700,000. That's a lot to stomach. And so can we see those kinds of drawdowns in the fall when typically we do see that seasonality play out? Absolutely. Now, there's a lot of momentum in the market right now. There's a lot of liquidity. Financial conditions are now as loose as they were when rates were near zero, and Trump is trying to force the Fed to lower interest rates, which is probably going to continue to fuel markets higher. But at the same time, you have a equity risk premium at the lowest level in decades and 10 stocks that make up 40% of the S&P 500. And so if you're a risk taker, buying the dips here, and maybe we get that weakness in fall. And if you're not and you want to protect your portfolio, just be a little careful out there and don't get caught in the FOMO.
Is it important that the Fed cuts interest rates? If they don't, could the market be in trouble?
Yeah, the market's factoring in that liquidity and lower rates. I personally think that the Fed should not cut interest rates. If you look at levels of unemployment, look at earnings. 83% of the companies in the S&P have so far beaten earnings expectations. Now, it's not stellar because it's the lowest growth rate since the fourth quarter of 2023, but it's still ahead of the 5-year average and 10-year average. Revenue is still okay. You've got a trade deal here. And you're not seeing the U.S. consumer respond yet to the higher costs that are being transposed into the economy. We could see inflation if these tariffs continue in the near term. And so taking a cautious approach and keeping some dry powder. If the U.S. enters into a recession for whatever means, and that certainly can happen, it's nice to have the ability to cut rates instead of cutting them ahead of time.
Yeah, keeping the old powder dry. You say you're not a bear, but you do have a certain number of conservative customers clients who don't want to lose money. And so what are you telling them right now?
Well, just don't get caught in the market euphoria that we're experiencing right now. At the same time, we're also saying, a couple of months ago, don't get caught in the extreme pessimism as well. So our job as advisors are to be the bellwether to keep calm and not let emotion enter the investment decision process. And to be okay with, if you're okay with an 8% average rate of return, which is what a 60-40 portfolio is done, don't worry about getting those double-digit returns and what NASDAQ rocketing back up 30-40% from the lows, because if you want to play that game, you're going to have to accept the big drawdowns. That's just the cost of entry. And so your timing is impossible to do to try and call the tops and the bottoms. And so, it just depends on, chart your own course and determine your own target rates of return and see if it's achievable in this market environment.
And dividend stocks, over time, they often do work out, don't they? Actual money in your hand.
Yeah, if you're targeting that like I said, 6 to 8%, you want to do there's a good old fashioned story of the tortoise versus the hare. You're going to get there with compounding. Some good stocks out there yielding 6%, 7% in Canada with a dividend yield. They're an oligopoly type of structures. They're protected. Even if the economy does roll over here and it looks like there's going to be some weakness, they'll continue to deliver. They have high profit margins and they have strong balance sheets. And so if you compound those dividends and you get a little bit of growth on top of that, getting 8% on a large portfolio as a retiree is pretty darn good.
What about commodity? What about oil, Martin? You're there in oil country. Do you think oil is going to get back to 70 anytime soon?
I don't. I think in the near term, probably range bound. OPEC has done a good job of managing the price range and keeping it and supporting the price. I do worry longer term though. U.S. rig count is dropping. I do worry about global inventories are at lows. The SPR is down. And now the excess capacity that was kept behind pipe is being brought on, so that won't be available. So if there's any disruption in 2 or 3 years from now, demand continues to grow at its current pace, we could see those higher oil prices. So, it's setting up for that to play out in the future, but just not in the near term.